Morning, everyone. Um, we are going to be looking at international finance, and when you look at international, can you guys hear me?
Yeah, we can.
Because there's someone who's posting that they can't hear me. All right. Just make sure that you check your settings on your laptop, or your phone, or whichever device you're using. So when you look at international finance, today we are just going to look at the first chapter, but you see that looking at as we look at the first chapter as well, we are not going to try to move too fast, mainly because there are so many other people who haven't yet joined, who are busy registering now. Because remember, the registration period is ending on the end of March. So which means we are expecting more students to be joining us for the classes as well. So because of this, we don't want to move too fast because initially when we prepared our timetable, we were preparing with an idea that the registration was ending on the 7th of March. So which means that we don't want to move too fast and end up disadvantaging other students as well. But either way, we still have to continue the classes as well. So when you look at international finance, the main thing that you're looking at here is where you're saying, when you studied financial management at undergrad, the main idea or the main concepts that you were looking at there, you were mainly looking at financial management from a perspective of a company that is basically trading and preparing its financial statements locally, right? So which means that there was very little, although they introduced you at some point to international finance, it wasn't really that much in depth, mainly because at undergrad level, you were concentrating more from company that is operating domestically and reporting domestically as well. So when you look at international finance, we are now looking at a situation where we're looking at a multinational company, and with a multinational corporation, we're basically saying that you are now having a situation where the company is not only having operations in its parent in its original or parent in the parent or where basically originally started, but it's now having operations in two or more countries. Now, when the company is having operations in two or more countries there, the main thing that we now have to worry about is what are the implications when it comes to exchange rate. So when you now take into account the effect of exchange rate, what are the implications? And when you're now having to now consider setting up a subsidiary or now trading with or buying or importing and exporting from what other countries as well, how do we now account for these transactions when we're now preparing our financial statements and we're now analyzing our financial statements? And also, how do we ensure that we're able to mitigate the risk that emanates from having an exposure to exchange rate? And also, it's not only exchange rate, you also look at the risk exposures that you're going to be having when you're now having to worry about the economic implications of your operations in other countries and how you are going to be able to mitigate those implications as well. So when you look at Fin4802, take note that the main perspective that you're going to be looking at it is from a perspective where you're looking at a multinational corporation. So you are, in most cases, you're going to be looking at it from a perspective where you're looking at a multinational corporation. So it means even though you are now looking at it from a perspective where the company is having a reach in more than one economy or in more than one country, it basically means that it doesn't necessarily mean that the basic principles of financial management are going to fall away. The goal of the firm stays the same. The goal of the firm stays the same, being to maximize shareholders' wealth. So for our curriculum, we are going to be looking at I'll give you a rundown of the chapters that we're going to be looking at. So the first chapter we're going to be looking at is chapter 1, which looks at the international financial management and overview. Then from there, we look at international flow of funds. Then we look at international financial markets. And then from there, we also look at exchange rate determination to see exactly what are the factors that are taken into account when you're determining the exchange rate. Then chapter 5, we look at currency derivatives. Now, when you look at currency derivatives, this is where you're now going to say, what are the methods that are used to mitigate the risk exposures when you look at the exchange rate risk exposures as well? So which means that there are different derivative instruments that are going to be looking at, where you're now going to be looking at derivatives such as the options, where you look at forward contracts, where you now look at situations where we look at a money market hedge as well. And in another situation where you say, if that is the case, how do you mitigate the risk, even if it's said what, to not hedge your positions as well. Then chapter 6 looks at exchange rate history and the role of government. So we need to find out exactly, so what is the role of government in the economic system, and how does the government now either directly or indirectly influence the movements, not exchange rates. Then chapter 7 looks at international arbitrage and interest rate parity. So now when you look at international arbitrage and interest rate parity, this is where you're saying, you as an individual, or as an organization, you can now be able to actually, because we know that the market value of a the market value of a particular transaction or security is not necessarily going to be the same as the intrinsic value of a particular transaction or security as well. How do you now take into account or make arbitrage profit from the what mismatch between the two as well? So that's when you're going to be looking at international arbitrage and interest rate parity. And there's going to be a formula that you're going to be looking at there, where if that formula doesn't balance, it basically means what? There's an arbitrage opportunity for you to be able to. And remember, when you look at arbitrage opportunity, you're basically saying that you're making a risk-free profit. So when you're moving between currencies, you're making a risk-free profit. Then chapter 8 looks at relationships among inflation, interest rate, and exchange rate. So we need to find out exactly, so what is the relationship among these as well, where you're now saying, how do these factors now contribute towards what? The whole exchange rate movements as well. Then chapter 9 looks at forecasting exchange rate. Now that you've looked at the relationship among inflation, interest rates, and exchange rates as well, now you need to find out exactly, so how are you able to forecast the different exchange rates? Then chapter 10 looks at measuring exposure to exchange rate fluctuations. So you need to find out exactly, so how do you measure your exposure to exchange rate fluctuations as an organization, depending on the type of transactions you're going to be entering into as well. Then chapter 11 looks at managing transaction exposure. Now, which means chapter 10 introduces you to the different exposures that you're going to be looking at. And chapter 11 now looks at individually managing transaction exposure, to say, what is transaction exposure and how do you mitigate the effects of what? Transaction exposure. Then from what we have been introduced in chapter 10, in chapter 12, we're also going to be looking at managing economic exposure and also translation exposures as well, which means that it's a build up from what we have done in chapter 10. Sorry about that. Then moving on to chapter 12, chapter 13, we also look at foreign direct investment, to say, how do you how do you assess foreign direct investment, and how does it overall benefits the multinational corporation when you look at foreign direct investment. And now the whole idea here is where you're now looking at to say, now, how do you mitigate the effects of exchange rate risk exposure? Because remember, from the exchange rate risk exposure, you will see that how do you now mitigate that effect? Like, for example, through international diversification, where you're basically saying that now, instead of you having borrowing or investing in one currency, you can now mitigate your international risk exposure by borrowing or investing in what? Different countries as well. Because the more you borrow in different, invest in different countries, it basically means that you are going to be expecting what? To reduce your exchange rate risk exposure as well. Then chapter 14 looks at multinational capital budgeting. So now we have seen capital budgeting in undergrad, where we look at capital budgeting to say, when you look at capital budgeting, you are saying your assets is equal to equity plus liabilities. So which means if your assets is equal to equity plus liabilities, you are now saying, how do we raise the money that is needed for us to be able to finance the what? The equity, the assets of the business. It's either you're going to be raising that money internally from the owners of the business, which is through equity, or you're going to be raising that money externally through debt financing. So now when you look at multinational capital budgeting, you are now looking at the implication now to say, so how do you now make a choice to say you are going to be borrowing locally? And how do you also make a choice to say, how now, which sources of debt financing are you going to be borrowing from as well? It's either you borrow locally, or you now have to choose whether you're going to be borrowing from country A or country B. And now you're going to be comparing to say, how much is my effective cost of borrowing if I borrow locally? And how much is my effective cost of borrowing if I'm going to be borrowing that money from what? From international sources as well. So remember, when you're now considering the borrowing of money from international sources, you also have to take into account the effects of what? Exchange rate risk as well. Now, it also means that that decision is also going to be based on your estimation of exactly how much the exchange rate is going to be going into the future as well. So that's basically what we're going to be looking at in chapter 14. Then chapter 15, we look at country risk analysis. We are now going to be saying what are the different components that makes up country risk the country risk, to say how much is the risk exposure that we're going to be exposed to when we are going to be borrowing from a particular country as well. Because remember, where country risk exposure comes in is where we are saying we know that the nominal rate of interest is given as the real rate of interest plus inflation premium plus a risk premium. So when you look at country risk exposure, you're now saying, what is the risk exposure emanating from here, which is also going to end up affecting what? Your interest rate. So which means this interest rate is now where you're now going to be saying, when you're considering whether to borrow locally or you're going to borrow from international sources, right? So now, when you're considering borrowing from international sources as well, it basically means that apart from the interest that you're expecting to pay from other risk factors as well, you also have to take into account country risk exposure, where you're now going to say, so what is the risk exposure from the country that I'm going to be considering what? Borrowing from? Because we know that there are so many different factors that contribute towards what? Country risk exposure. Like, for example, political instability, or if there's going to be the general attitude of that of the government that you're going to be looking at there as well. So all these, they end up increasing or decreasing your risk exposure, risk premium, which also ends up affecting what? Your interest rate. So this interest rate is basically what is going to be affecting your rate of interest. And you'll see that your effective borrowing, so when you're looking at borrowing from international sources, your effective interest rate is generally going to be made up of what? Two sources. It's going to be the interest from that you've determined here, from the domestic, from the country on its own, or from the market that you're basically considering borrowing from. Then you're also going to, it's also going to be affected by the what? The effect of what? Of exchange rate. So which means this complexity is now the one that you take. That's why you see that we have to study what? International financial management as well. Because remember, these two, getting that information domestically is easier when you look at financial management domestically. So when you're now considering borrowing locally, they were basically assuming that getting that information on exactly what contributes towards your interest rate that you're going to be charged domestically is easier to determine. But now, from international financial management perspective, they're also going to say, how do we now take into account the different components of risk which are going to be affecting our risk premium from the country that we're going to be borrowing from, which ends up affecting the nominal interest that are going to be charged, from the country that we're going to be borrowing from. And then we also need to determine exactly what is the estimation of the what exchange rates going to the future. Because remember, what we know with certainty is what the exchange rate is today. But what we don't know with certainty is the estimation of the exchange rate 1 year from now, 2 years from now, 3 years from now. Because remember, some projects can end up running for either 5 years, 10 years, or even 30 years, or even longer than that as well. So which means the estimation of the exchange rate is going to end up affecting our estimation to see exactly how much is going to be the effective cost of borrowing from the international sources of financing that we're going to be getting. So that now is now going, so those estimations are going to be very, very important, because this helps you make a better informed decision on your decision to say, are we going to borrow this money locally, or are we going to borrow it from what? International sources as well. Are we on the same page? Any questions? Then Unit 16 then we also look at long-term financing to say what are the effects of borrowing from a long-term financing perspective, and we also look at short-term financing as well. Then we're also going to be looking at financing international trade. Then where we're now going to be saying that if we're going to be having international transactions, how do we finance international trade? Like, for example, if we're going to be importing and exporting goods internationally as well, how do we now finance those transactions when you look at what financing international trade as well? Then you're also going to be looking at short-term financing, which is Unit 18. Then Unit 19, we're not going to be looking at it. So Unit 19, we're not going to be looking at it, and also 20 as well, we are not going to be looking at them. So also, as a side note, please go, I've given you the chapters that we're going to be looking at. So there are some chapters or study units that we're going to be looking at, which are not necessarily the ones in the textbook. So if you check under my UNISA as well, you will see that you will have study additional reading 1, 2, and 3. So from the study units that we've looked at there is going to be some study units which are going to be covering additional reading 1, 2, and 3, which are not necessarily the chapters that are going to be that are going to be in the textbook. So it's the chapters as mentioned in the textbook, but the material that you're supposed to be using there is based on the additional reading 1, 2, and 3. So you see that additional reading 1 looks at multinational cost of capital and capital structure. Then when you look at international additional reading 1 here, you are basically saying that from a multinational perspective, how do you determine the cost of capital? Because remember, we have seen that there are different elements that ends up affecting the risk premium there, right? So there are different elements that end up affecting risk premium. So how do we determine the cost of capital from an international perspective? So which basically means that when you look, there is a formula that we're going to be learning, which way you are able to now going to be able to convert the cost of capital from a domestic perspective to an equivalent cost of capital from a what? And an international perspective, or to another country's what? Perspective as well. Then there's also going to be additional reading too, which looks at multinational capital budgeting. So you'll see that the multinational capital budgeting chapter that we're going to be looking at there is not the one based on the what's in the textbook. It's going to be the one based on the what additional reading as well. Then there's also multinational restructuring. So when you look at multinational restructuring, this is where you're not going to be saying, for example, if you're having operations in another country, we know that the economic conditions are going to be changing over time. So if the economic conditions are going to be changing over time, this is where you're now saying, okay, fine, the goal of the firm is to maximize shareholders' wealth. So how do we ensure that we're able to maximize returns and minimize our costs? Because remember, for you to be able to maximize shareholders' wealth, in the short run, you need to be able to maximize the returns and minimize the costs. So for you to be able to maximize the returns and minimize the costs, how do you ensure that you are now going to be able to do restructuring of your finances? Like, for example, when you look at restructuring, this is where you're now going to be saying, for example, if I have subsidiary in country A and in country B as well, and I have my own domestic operations, how do we ensure that maybe you see that in country A, it's becoming what more and more expensive to borrow, or for example, the cost of debt is becoming more. So how are you going to be able now to restructure your operations so that you're able to borrow from a country which results in what the lowest effective cost of financing is possible? Then this is basically a typical example of multinational restructuring, because you're basically saying that our goal is to maximize returns and minimize the costs. So over time, as you're assessing your international operations, how do you ensure that you're able to maximize that relationship? By looking at the cost of borrowing, and also by looking at what your potential returns that you're going to be generating from those operations as well. So please take note of this. So this basically means that as you're going through Fin4802, always make sure that don't go according to the textbook, because you see that I think the first 10 or 11 chapters, or the first 10 chapters, the study units are usually are going to be according to what's in the textbook. But don't get carried away by just going through everything in the textbook sequentially the way they're given, mainly because there are some sections where we're not going to be referring to the textbook, we're going to be referring to the additional readings as well. So try as much as possible to stick to the study guide, because the study guide will tell you which chapter you're going to be looking at, and based on the chapter you're going to be looking at, then it basically means that you're now going to be looking for that particular chapter in the textbook as well. Are there any questions? Are there any questions? All right, so let's have a look at chapter 1. So chapter 1 is also based on study unit 1. So chapter 1 is also based on study unit 1. And for study unit 1, we look at the multinational financial management and overview. And looking at the overview, they tell us that the commonly stated goal of a firm is to maximize its value, and then therefore maximize the shareholders' wealth. So remember what you've learned at second year when you're doing financial management, and also reminded in third year when you're doing financial management as well. What is the goal of the firm? Even if you look at it, whether from a domestic firm or international firm with an international footprint as well, you will see that the goal of the firm still remains the same. The goal of the firm is to maximize shareholders' wealth. And how do you maximize shareholders' wealth? By maximizing what? The value of the firm. And how do you maximize the value of the firm? By maximizing the firm's what? Share price as well. So which means in this case, if you look at that paragraph as well, they also say, consequently, many firms have evolved into multinational corporations, which are defined as firms that engage in some form of international business. So their managers conduct international financial management, which involves international investing and financing decisions that are intended to enhance the value of the multinational corporation. Then they also say, international, I'm basically going through the most important section, which is basically the one that I've highlighted here. So here they also say, international financial management is important even to companies that have no international business, because these companies must recognize how their foreign competitors will be affected by movements in exchange rates, foreign interest rates, labor costs, and inflation. So such economic characteristics can affect the foreign competitors' cost of production and pricing policies. So which means even if you're a company that is basically producing goods locally in South Africa and selling to the local domestic market as well, you are going to be very much interested to find out exactly, so what are the factors which are going to be affecting the goal of the competitor firms as well. If the competitor firm is going to be coming from China and is also going to be supplying goods to you and competing with you in the domestic market as well, it's of much importance to you to understand exactly what is happening with the global supply chain. What is really happening with the movements in what exchange rates? What is the overall effect on the war in Ukraine? How is it going to end up affecting what our operations, and how is it also going to end up affecting what the operations of our competitors as well? So which means, because the world is now becoming a global village, it basically means that it's no longer back in the same as back in the days where if you're having a store, like for example in the rural area, where you really, the only source of supply that the customers knew is basically that store in the township, right? So which means in the rural area, they'll be you knew that you didn't really have much of a competition, because the only competitor is basically the people in your surrounding or at the other shops as well. But now, because we're becoming a global community, it's no longer like that, like what it was back in the days. Because of the progression in technology, information technology, and like for example through the internet as well, you see that the customers are having what more and more options. So which means, just like what you see as well, just because your local area, like for example, if you're staying in a local area, like let's say for example you're staying in Pretoria, in Pretoria Central, and maybe there's no Checkers there, it does not necessarily mean that your customers are, if you're going to be having, like let's say for example in a simple term, you're having you're a supermarket operating that area, and you're the only supplier in that area that is basically a supermarket. Let's say for example supermarket A. Other supermarkets are now going to be able, because of the progression in information technology, other supermarkets are competing now, because that's where you see that, for example, other suppliers like Pick n Pay and Checkers, they're now able to deliver goods. You just go on the app, you order the goods, and then they deliver them to you as well. So which basically means that it's no longer like back in the days where you were only worried about competition from the suppliers or from the other suppliers who are basically the one in the reach of the region that you can see as well. You are now having a situation where you're having to compete with other people who are able to provide the same services as you through the internet. So because of this, you will see that it's now becoming more and more complex for you to be able to do a market research, to see exactly what is the demand and supply of your goods, and for how long are you able to sustain that as well. Now, moving on to the next section, we look at the goal of the multinational corporation. And here they say, the commonly accepted goal of such a multinational corporation is to maximize shareholders' wealth. So which means just like a company operating domestically, a foreign multinational corporation as well, the goal of the multinational corporation is still the same, is to maximize shareholders' wealth. Now, on the next section, we look at conflicts with the multinational corporation goal. And here they say on line numbers 5, they say, when a firm has only one owner who is also the sole manager, such a conflict of goals does not occur. So the conflict of interest, the conflict of the goal between the party who's running the organization and the owner of the business, usually for a sole proprietorship or for a sole trader, it does not necessarily happen, mainly because the idea would be a sole proprietorship is also everything. They are the supplier, they are the finance manager, they are the ones running the shop, they are the ones doing everything. A simple example of understanding a sole proprietorship is the ladies selling maguinas on the street. They are basically doing everything. They do the procurement, they manage the finances, they are the ones doing the making of the maguinas, they are the ones selling the maguinas, they are basically doing everything. So which means there is little room for conflict of goals as well, mainly because they are trying to act in their best interest. So it also means that by acting their best interest, they're also acting the best interest of the organization as well. But now they also say, however, when a corporation's shareholders differ from its managers, a conflict of goals can exist. This conflict is often referred to as the agency problem. So the cost of ensuring that managers maximize shareholders' wealth, which are the agency costs, are normally larger for multinational corporations than for purely domestic firms for several reasons. So which means for multinational corporation, so you find a situation where a company like, let's say for example, the company like MTN, it's got operations in South Africa, it's got operations in Botswana, it's got operations in Nigeria, it's got operations in Iran, it's got operations across the world. So for a typical company like that as well, it means that the agency problem is likely to be high, mainly because you have different regional heads there. So which means those different regional heads as well, are they going to be in a position where they are acting at the best interest, in the best interest of the organization, or are they going to be pursuing their own agendas as well? So which means in this case, they say the first reason why the agency problem is greater for multinational corporations than a purely domestic company or a purely domestic organization is mainly because they say, first, multinational corporations with subsidiaries scattered around the world may experience larger agency problems because monitoring managers of distant subsidiaries in foreign countries is more difficult. So monitoring the managers is more difficult, although the progression in technology is make it a little easier as well. Because remember, picture this, back in the days when the company was a multinational corporation, there was a manager now who had to now move to, for example, fly to Botswana, stay there for a week, see what's happening, then go and fly to Nigeria, stay for a week, monitor what's happening and review to see if everything is fine. From there, go on to Iran, monitor the operations, see what's happening, then they come back. So there was a lot of traveling that had to be done but now, because of the progression in the internet, you will see that it's becoming easier, mainly because it means that the managers can now be able to set up Zoom meetings regularly. Like for example, if it's going to be Zoom or Microsoft Teams or anything like that. So which means that because of this, it has made it a bit easier. But now, either way, it's difficult to also know what's really happening on the ground, although you're able to get more frequent feedback, but it's not as easy as running your own local operations, where with your own local operations on a daily basis, you're able to physically see what is happening as well. So the first problem there is that monitoring the subsidiaries and what the managers of the subsidiaries are doing is a bit more difficult for when you look at multinational corporations. They're not a purely domestic organization as well. Excuse me. The second reason, they say, second, foreign subsidiary managers raised in different cultures may treat the goals of its multinational corporation in different way from that intended by senior management. So which means people from different cultures and different backgrounds, it basically means that those managers are going to be behaving differently as well. So which means you might have a situation where, because of the organizational culture, because of the different cultures or backgrounds that people are coming from as well, the way they do business and the way they conduct themselves might be different. So which means because of this, it makes it now difficult to actually coordinate all these people as well. Like, for example, you look at, if you compare the work ethics in Japan and you compare the work ethics in countries like China, and you compare the work ethics in Africa, and even when you compare it with the Western countries as well, and then you compare the work ethic from maybe some of these islands as well, it's going to be very, very difficult, because these are people from totally different cultures, and they've different norms as well. So which means because of this, it's going to be very difficult for the managers, if the company is originating from, let's say, from China, there is a particular work ethic that they are used to. And because of that, it's going to be very difficult for the managers now to understand exactly how do we adjust to the different cultural backgrounds that the managers are coming from as well. Then the third one is that they say the sheer size of the larger multinational company can also create communication problems, mainly because when you're looking at the sheer size of the multinational corporation, you are now having a situation where you are going to be having, like, for example, a company that is going to be having a big footprint. You look at a company like, let's say, for example, in simple terms, you look at a company like Coca-Cola, it's basically all over the world. So how do you now manage communication and coordinate with the different managers as well? And sometimes you also realize that different regions across the world, we have different time zones. And because we have different time zones, you realize that when it's morning, this side, it's 8:51 in the morning here in South Africa. It means that in another part of the US, probably it's at night. And if you look at it in China, it's probably another type of different time zone as well. So because of the different time zones, it makes it very difficult. And now look at organizations which are basically having a very big footprint spread across the world as well. It's going to be very difficult to actually coordinate communication with the different subsidiaries as well. Then the fourth one, they say the fourth complexity of operations may result in decisions for foreign subsidiaries of the multinational company that are inconsistent with maximizing shareholders' wealth. So which means, because you're having a very complex organization, it's going to be very difficult now to ensure that the decisions that are being made by the different managers from the subsidiaries as well are necessarily going to be able to achieve where the company or organization is trying to go, which is basically maximizing shareholders' wealth. So you might find that because of the different backgrounds that people are coming from, and because of the different way of working, and because of the different way things are done, or the way they run operations as well, is going to be very difficult for the different subsidiaries as well to be able to make decisions which are going to be maximizing shareholders' wealth. So these are some of the reasons why it's going to be a bit more difficult to manage and coordinate to coordinate the different sections of the different subsidiaries of the organizations to be able to maximize the shareholders' wealth. Is there any question regarding these 4 reasons? Any question? Now, yes?
Morning, sir. I don't have a
Morning.
question.
Mhm.
I don't have a question, but I have a request. Sir, may you kindly share the soft copy of this textbook, because the vision that I have is not the same with the vision that you have.
All right. Do you have a user account as yet?
User account on my UNISA.
Okay. Okay, there are those who are coming from. All right, no, it's fine. I'll make sure that I share the soft copies on the different WhatsApp groups as well.
Thank you so much.
All right. So you might see that the different sections are not necessarily in the same order, but if you check in your textbook, the sections are given, the headings are there, and the sections are given as that, but maybe the numbering of the pages and the way they arrange the sections might be a little bit different as well. Now, on the next section, we look at the impact of management control. Now, remember we've said that with a multinational corporation, we have different subsidiaries from across the world. Now, how do we now ensure that, and we have seen that there might be agency problems where we're trying to make sure that these different subsidiaries are in line with what the goal of the multinational multinational corporation is as well. So when you look at the impact of management control, this is where you're not going to say, so what sort of organograms are we going to be looking at, where we're going to be looking at the structuring of that, the relationship between subsidiaries and the parent company as well, or the parent company. So which means in this case, they say the magnitude of agency cost can vary with the management style of the multinational corporation. A centralized management style is illustrated on the top section of Exhibit 1.1, can reduce agency costs because it allows managers of the parent direct control of the foreign subsidiaries and therefore reduces the power of the subsidiary managers. However, the parent managers may make poor decisions for the subsidiary if they are not as informed as subsidiary managers about the local financial conditions. So when you look at a centralized multinational financial management system, this is where we are saying the different departments, like for example, this parent company is a multinational company, it's got a subsidiary A and it's got another subsidiary B. So if you're having a centralized system, we're basically saying all these different departments, they are not coordinating or reporting to someone within the organization, their own different or individual organization. They directly report and coordinate with the manager from the parent company as well. So which means the cash management department, the stock and data management department, the finance management department, and the investment management department as well, they are all directly reporting to the financial manager from the parent company for both subsidiary A and subsidiary B. So that's when you're having a centralized organization or system. Then with the decentralized system, this is where we are saying all these different departments, they are reporting to the manager who's going to be overseeing, for example, subsidiary A. And for subsidiary B, all these departments are going to be reporting to a manager who's going to be overseeing subsidiary B. Then these managers now are the ones who are going to be communicating with the manager from the what? Parent company. So which means with a decentralized system, they say, alternatively, a multinational corporation can use a decentralized management style as illustrated in the bottom section of Exhibit 1.1. This style is more likely to result in higher agency costs because subsidiary managers may make decisions that do not focus on the maximizing the value of the entire multinational corporation. So you're basically saying that you are giving the different managers from the different subsidiaries the autonomy to be able to make decisions as well. But now the risk is as well is that these managers might not necessarily comprehend the decisions or how it's going to end up affecting the overall or the whole organization as well. So because of this, you might have a situation where they make decisions which are not necessarily going to be able to maximize the value of the shareholders of the overall organization. So here they say, given the obvious trade-off between centralized and decentralized management styles, some multinational corporations attempt to achieve the advantages of both styles. That is, they allow subsidiary managers to make the key decisions about the respective operations, but the parent management monitors the decisions to ensure that they are in the best interest of the entire multinational corporation. So this is more like a hybrid between a centralized and decentralized system. On the next section, we look at how the internet facilitates management control. And here, they are basically discussing to say, when you look at the progression in the internet, it has actually allowed management to have a better control on the operations of the subsidiaries, mainly because, like what I was saying, the Skype calls, the Zoom meetings, and all those other things as well, they've allowed the management to be more working more and having a better communication system with with the different subsidiaries and the managers of the subsidiaries as well. So they are going to be able to get a more updated information of the operations of the different subsidiaries as well. On the next section, we look at impact of corporate control. And when you look at impact of corporate control, we don't have to worry about this section. We don't have to do this section. It's not in the new textbook. So on the next section, we look at constraints interfering with the multinational corporation's goal. Constraints interfering with the multinational company's goal. And here we look at environmental constraints. And here they say, each country enforces its own environmental constraints. So the threat by multinational corporations to locate elsewhere in the face and overly harsh local environmental laws acts as a significant restraint to countries wishing to pursue a strong environmental policy. And you have when it comes to the environmental constraints there for multinational corporations, you are finding it quite a lot as well, especially when you look at Africa, where over time, historically, we know that multinational corporations, they were able to do as they wish with very little constraints when it comes to the effects of the environment. But we now know that over time, the governments in Africa, they are now starting to impose environmental constraints. Like, for example, when you look at mining, where when a company says that they want to set up mining operations, they are asked to set up a reserve to ensure that there is enough money to rehabilitate the environment after they are done with their operations as well. But what we also know, it also means that historically, they didn't have to set up that fund to rehabilitate the environment. That fund was basically contributing towards their profitability as well. So which means that when you look at constraints interfering with the multinational goal, we know that there's also going to be an issue of the environment, although we know that this is basically going to be in the best interest of the community as well. That's why you see that in most cases, there is usually friction between a company wanting to do operations and the local community as well, because the local community is going to be complaining about the environmental effects of those operations as well. Like what we see, what is happening in the Cape, I think I can't remember exactly which type of mining operations where even the Minister of Mining was getting involved in the court case as well. Then we also look at regulatory constraints, where they say each country also enforces its own regulatory constraints pertaining to taxes, currency convertibility, earning remittance, employee rights, and other policies that can affect cash flow of a subsidiary established there. So when you look at regulatory constraints, this is where we look at the laws of which affects the operations of the subsidiaries for the multinational corporation. A typical example of this is where we find, if you remember a few years ago, where MTN ended up being fined by the Nigerian government because they remitted the funds before the set time or without the before the set time, which was not necessarily in agreement with the Nigerian government as well. And you saw that MTN ended up being fined, and there was also issues with the banks that also facilitated the transaction as well. So which means there is usually those regulatory constraints which are also affects the movements of cash flows within between the parent company and the subsidiary as well. Because remember, in most cases, the parent company invests the money, and over time, they expect some of the profits to be remitted as well. So which means that now when it comes to the remittance of the profits as well, we have to make sure that they also are according to the regulatory constraints or according to the laws of how the flow of funds should be done from that particular country as well. The other issue is ethical constraints, where they say there is no consensus standard of business conduct that applies to all countries. So a business practice that is perceived to be unethical in one country may be totally ethical in another. So which means in this case, they say bribes to governments in order to receive special tax breaks or other favors are common in some countries as well. And we also see a typical example of this is where we see the issue of MTN, where they were being taken to court by an American company that they were competing with when it comes to telephone network set up for I think it was in Iran, where they were taken to court by that company. I can't remember exactly how that court case ended up, but you saw that they were being accused of paying bribes to the local authorities to be able to get that contract as well. So yeah, so which means that you have to take into account the ethical constraints when it comes to the operations of multinational corporation as well. The next one is managing within the constraints. And here they say, some multinational corporations have made the costly choice to refrain from business practice that are legal in certain foreign countries, but not legal in their home country. So thus, they follow a worldwide code of ethics. So this may enhance their worldwide credibility, which can increase global demand for their products. That's why you see that in most cases, the managers and the different parties in decision-making positions for the organizations, they usually belong to a particular professional body. And remember, when one belongs to a particular professional body, it means that they are also expected to conduct themselves within the rules and regulation of that particular professional body as well. Which means that if they're able to, as they are restricted to act within the rules of conduct of code of ethics which are set up in those professional bodies, they are going to be acting they are going to also ensure that whatever decisions that they're going to be making for the multinational corporation, they're also going to be within the ethical constraints as well. So which means in this case, it means that you see that because of the professional bodies, it means that many parties who are in the decision-making positions for many organizations, they are basically going to be expected to act ethically as well. Are there any questions so far? Any questions? Next, we look at theories of international business. And looking at theories of international business, they say there are two broad categories, economic and business-related theories. Economic theories address the problem at national level, looking at how countries can increase the overall level of wealth through international trade. Then they also say business theories are based on observation. They seek to find common patterns of development of international business and model these patterns into a coherent explanation. So when you look at economic theories, they say the first economic theory that they discuss here is the theory of absolute and comparative advantage. So those are the two theories when it comes to economic theories. And when you look at the theory of absolute advantage, they say the theory of absolute advantage was first formally stated by Adam Smith and conforms to what most non-specialists would advance as an explanation and justification for international trade. Suppose country A is more efficient at producing food and country B is more efficient in producing machinery in a two-country world. So the world production of food and machinery can be increased by specialization. So which means in this case, country A should produce more food than it needs at the expense of some machinery production, and country B should produce more machinery that needs at the expense of some food production. So country A can then trade some of the surplus food for some of country B's surplus machinery. So the important point here is that through better use of resources by means of specialization, the world totals of food and machinery are now higher than before specialization as well. So this is basically what we look at when you look at what? The theory of absolute advantage. Is there any question regarding that theory? Next, on the next paragraph, we look at the law of comparative advantage. And here they say, so starting from the start of the paragraph, there they say, the economic David Ricardo extend this analysis to the law of comparative advantage. He asked the question, equivalent question 2, what if A was less efficient at producing food, as well as being less efficient at producing machinery? He showed that if A produced more of the product at which it was comparatively less inefficient, it was still possible for a world production level of food and machinery to be increased, and both parties could still benefit through international trade. So suppose that in this example, that country B is developed its food and production and becomes slightly more efficient than country A and remained more efficient at producing machinery. This would still be benefits to both parties of A if A specialized more in food and B more in what? In machinery as well. So this is basically where you look at what? The law of comparative advantage. Is there any question regarding the law of comparative advantage? Now, apart from those two, there is also the imperfect markets theory. And here they say, countries differ with respect to resources available for the production of goods. Yet, even with such differences, the volume of international business would be limited if all resources could be easily transferred among countries. So if markets were perfect, factors of production would be mobile and freely transferable. So the unrestricted mobility of factors would create equality in costs and returns and remove the competitive cost advantage. However, the real world suffers from the imperfect market conditions where factors of production are somewhat immobile, where we're saying people are not willing to move. Like, for example, if the labor market was perfect, it would basically mean that if someone had an opportunity to work in Cape Town, they would freely move and go to work in Cape Town without considering everything else, which means that it would have been very easy to move that person from Joburg going to Cape Town. But we know that because of different other factors as well, it's very difficult for a person who has been given an opportunity to go to work to Cape Town to just take off and go start working in Cape Town. Because sometimes you see that they start considering if they are married, they start considering their partner, they also consider the children, they also consider so many other factors as well, which might end up restricting the free mobility of their skills to be utilized in Cape Town, for example. So here they say the overall wealth can be increased as imperfect markets provide an incentive for firms to seek out foreign opportunities and produce wealth that otherwise would not have been created. So which means that if firms are, for them now create an incentive for one to move to Cape Town, it basically means that if they now say, for example, included in your package, we're giving a bit more money, we're going to ensure that we facilitate your transfer to Cape Town, we make sure that your family is set up or anything like that. It basically means that so it means that to try to fight this imperfect market effect as well, it basically means that firm can now try to fight it through the use of incentives as well to be able to have more labor, for example, more labor mobility. Are we on the same page? Now, the next set of theories that I'm going to be looking at is business theories. And when you look at business theories, the first theory that I'm going to be looking at is the product cycle theory. And if you read through the paragraph there, they say, one of the more popular explanations as to why firms evolve into multinational corporations is the product cycle theory. According to this theory, firms first become established in the home market to meet local demand. A lack of information and a lack of resources creates a preference for single market development. Where the product is successful, the firm will experience foreign demand for its products and from exporters, foreign companies, or even via the Indian from foreign customers. So as time passes, the firm may feel the only way to retain advantage over competition in foreign countries is to produce the product in foreign countries, thereby reducing transportation cost. So when you look at the product cycle theory, here they're saying, when you look at the level of sales over time against time as well, they say initially the firm creates the product to meet local demand. Then over time, because of the increase in demand of the product, not only locally, but from the local customers, from the foreign customers as well, the firm starts to export the product to meet foreign demand. Then, as the demand is grown enough, they realize that, there's enough demand of our goods in a particular country. So instead of us having to incur transportation costs all the time to transport those goods into to the foreign market, or to a particular country, why don't we have now a situation where we're now going to end up setting up, for example, subsidiaries not in those foreign countries as well. So this is the third phase where you're now having a situation where the international market stabilizes, production located internationally to exploit what cost savings, because now you've seen enough demand of your goods or services internationally or from a particular country as well, which means that the next phase would be to set up subsidiaries as well. And in a way, you're trying to what cut down on production costs or transportation costs as well. So this is basically what they look at when you look at production cycle, product life cycle theory as well. Is there any question regarding the product cycle theory? Any question? Next, we look at global strategies. And here they say, international business is seen as a product of global strategies being pursued by multinational corporations. So the large investments required for medical research can be recouped by patenting and marketing the products worldwide. So when you're now looking at business theories, you can also look at what global strategies, where you're now going to say, how do we ensure that we're able to distribute our products globally? And also, how do we ensure that we're able to protect our product as well globally as well? And one way is through patenting as well, by making sure that you patent your goods globally, and at the same time, you also make sure that you continue marketing your goods globally. Like, for example, you've seen that over time, as big as Coca-Cola is, one way or the other, they continue marketing their products. They continue producing adverts for their products as well. So is there any question regarding business theories? Is there any question regarding business theories?
Good morning. Good morning.
Morning.
Hi, this is Busiso. I've been listening attentively to the theories. Yes. I do not have a question as well per se, but I can't find it in the chapter 1 of the book that I have. I have the 5th edition of International Financial Management, which is from Jeff Madura and Roland Forex. So I'm not sure if you have, are you using the 5th edition, or is it a latest, which is sixth, or the prior one, which is 4th? I'm not sure. So can you please enlighten?
What I'll do is I'll highlight it. What I'll do is that I'll go back and I'll look at my textbook, then I'll highlight it for you to show you exactly where in the textbook it is going to be as well. But I'll make sure. You said you're utilizing the 5th edition.
5th edition, yeah, because it could be maybe in chapter 3 or 4, but I was browsing through other chapters just to quickly check if I can find those theories, but now
I'll not. Just send me a WhatsApp. I'll communicate with you so that I'm able to coordinate with you as well.
Alrighty, thank you.
Okay, all right. All right, can you take a few minutes break until 9:30? Then at 9:30, we're going to look at international business methods. It's going to take a few minutes break until 9:30. Then at 9:30, we look at international business methods. So can you take a few minutes break until 9:30? Then at 9:30, we're going to be looking at international business methods.
Okay, since we are taking a few minutes break, if possible, can you please share the document so that some of us can print all of them teaching? Because we don't have any study material, some of us we haven't received, so the textbooks are not the same here and there. So maybe we can use the minutes you just gave to print so that we'll be on the same page with you, if possible. Greetings. I'm not sure if you did receive my previous message where I was requesting that if possible, can you please share the notes you are using during these minutes so that you can print?
All right. I'll share them. Can I do this? Can I, after the class, can I just quickly, because there's nothing much that we need to do after this. After the class, can I just share the textbook on the WhatsApp groups? I'll share the textbook on the WhatsApp groups. All right, can we continue? On the next section, we look at international business methods. And under that, they say, firms use several methods to conduct international business. The most common methods are international trade, licensing, franchising, joint ventures, acquisition of existing operations, establishing new foreign subsidiaries, and on top of that, there's also setting up a special purpose vehicle as well. So another method would be setting up a special purpose vehicle. So under this, when you look at international trade as an international business method, international trade, you are looking at the importing and exporting of goods and services. So under the international trade, you are looking at import and exporting of what? Goods and services. Then after this, and we also see that the importing of goods and exporting of goods and services is now, if you look at it now from an international trade perspective, now we see that it's more facilitated by the use of of the internet. Like for example, now you're able to go on Amazon, you're able to go on AliExpress, and you're able to, which means that you're able to actually import goods from China directly as a customer as well. Then the other one is licensing, and under this they say licensing involves selling copyrights, patents, trademarks, and trade names or legal rights in exchange for fees known as royalties. So licensing allows firms to use their technology in foreign markets without major investment in foreign countries and without the transportation cost that results from from exporting. So another way of doing international business is through licensing. The next one is franchising. And here they say, under a franchising agreement, the franchisor provides a specialized sales or service strategy, support assistance, and possibly an initial investment in the franchise in exchange for periodic fees. And typical example of international franchises would be McDonald's, Pizza Hut, and then you also look at what is that? Burger King as well. Those would be typical examples of international franchises as well, which means that it allows those companies as well to be having an international footprint through franchising as well. Then there is also joint ventures, where they say a joint venture is a venture that is owned and operated by two or more firms. So which means the firms, they are still maintaining their own independence as well, but they are coming together towards one particular goal as well. So which means that when they go into a joint venture, in most cases it would be a particular project that they want to be able to protect, and based on that particular project, now the firms now join their resources together towards for them to be able to pursue a particular project as well. And in most cases, you find that joint ventures are usually done on a large scale where there's quite a lot of financing that is needed as well. So which means that there's quite a lot of financing that is needed. There's quite a lot of risk that needs to be taken as well. So because of this, that's why you find that in most cases, that's why you find a lot of joint ventures being formed as well. Then there is acquisition of existing operations. So this is where firms frequently acquire other firms in foreign countries as a means of penetrating foreign markets. And under this, they also say the risk is that too much has been paid for the acquisition, also that there is unforeseen problems with acquiring with the acquired company. So it has to be remembered that the seller of the company has a thorough knowledge of the business, and the price at which they are selling is presumably higher than their estimate. So which means when you look at acquiring an existing operation, this is where, for example, you have a South African company, it's considering spreading their operations to Botswana, for example. So what do? Instead of now starting from scratch with operations, they just go and buy a particular company, a particular operation. So they go and buy, for example, a particular company. And then when they buy that particular company as well, it basically means that the company already has an existing market. It already has an existing footprint. So that's basically what they're going to be buying into as well. But the risk there is that the seller know more about the company or the intricacies of the company that is being bought by the acquiring company than the acquirer as well. So because of this, you might have a situation where the acquirer might not necessarily end up being having a situation where they might end up paying more than what the company is actually worth, or they might have a situation where there might be unforeseen problems that they have not would have not actually filtered in when they're buying into this company as well. Because sometimes you find a situation where the seller might be selling because they have some other knowledge of exactly they know a lot more about what is happening with the company and in which direction the company or the industry is taking. So which means that the foreign buyer might come into the industry without that prior knowledge as well. The next one is establishing new foreign subsidiaries. So here, this is where they say the firm can penetrate foreign markets by establishing new operations in foreign countries to produce and sell their products. Like a foreign acquisition, this method requires a large investment because remember, this is where, for example, a South African company wants to have a footprint in Botswana. So what do? They now go into Botswana and start establishing the subject from scratch. They have to go get the building, look for the labor, look for everything there so that they're able to actually start operations as well. So which means that there's a lot of an investment that is needed from the parent company. And then there's also quite a lot of risks that they're going to be going into because they also need to do market research, and there's no already an existing operation that is already there as well. Then the other method that is not necessarily in this particular textbook is the establishment of a special purpose vehicle. So with a special purpose vehicle, this is where the parent company can establish a special purpose vehicle, which is basically, so when you look at a special purpose vehicle, this is a separate entity that is created with a sole mandate. So it's a separate entity that is created with a sole mandate. So its mandate can be either to raise, in most cases, it's going to be able to raise the funding that is needed as well. So which means that, for example, the parent company can be wanting to raise money for whatever project that they pursue. So they create a special purpose vehicle, and through this special purpose vehicle, they use this special purpose vehicle to actually be able to operate independently, and the sole purpose being to, for example, to access the funding that is needed in that particular market as well. And then they find ways of actually giving security for the special purpose vehicle. Like, for example, they can be utilizing the parent company's, some of the data from the parent company now to be able to for the special purpose vehicle to be able to access the funding in that particular local market. Like, for example, you might have a situation where the parent company currently is exporting goods to Botswana, right? So the parent company is currently exporting goods to Botswana. So as it stands, they might have a situation where they have customers in Botswana who are owing them money. But now they might have a situation where they might need to have access to the money, to the funding now, instead of getting that money or funding later on. So what do? They can now create a special purpose vehicle in Botswana that is registered in Botswana. Then they now utilize, they now give away, or they now utilize as funding for the special purpose vehicle. They take the data that are being owed to the parent company, and then they become the data of the special purpose vehicle. So which means that when the special purpose vehicle now approaches the financiers in Botswana as well, they can now be as an asset that they have. They can now be utilizing the data is now to say, we are being owed this much. Can you be able to give us funding to for our operations, so that, and as a security, we're utilizing what the data that are being owed as what as security as well. So that's basically how a company can be able to do international business when you look at what through the use of what special purpose vehicle. So is there any question regarding the different ways in which a multinational corporation can be able to do international business? Any questions? Is there any question? The next section that we're going to be looking at is exposure to international risk. So we're going to be looking at exposure to international risk. And here they say, although international business can reduce a multinational corporation's exposure to its home currency economic conditions, it usually increases the multinational corporation exposure to exchange rate movements, foreign economic conditions, and political risk. So when you look at exposure to exchange rate movements, this is where we are basically saying that the movements in exchange rates can end up what affecting the company as well. Like for example, if you look at Barclays, remember Barclays around 2004, 2005, somewhere there, they invested in South Africa. And when they invested in South Africa, let's say, for example, they were investing in US dollars. Their main capital was in US dollars. So which basically means that, and during that time, the exchange rate was around $1 was equals to about 6 rand or 7 rand, somewhere there. So you find that when they invested in South Africa, the rand was strong. Then they converted this money, the investment in South African rand. Then now, when they decided to start disinvesting, that was after around 10 years or so, the exchange rate was now around 13, 12, or I can't remember exactly how much that was as well. Around 11 to 13 rand is equals to $1. So you have a situation where they would have actually lost money from their investment due to the movements in what? In exchange rates. So this is basically what we mean when you look at what? Exposure to exchange rate movements, which increases what? Your international risk as well. So international risk can be caused by exposure to exchange rate movements, where we are saying that the movements in the exchange rate can end up resulting in what? Losses to the investment by the what? By the investors as well. So is there any question regarding the international risk exposure due to exchange rate movements? Any question? The next one is exposure to foreign economies. And here they say, when the multinational corporation enter foreign markets to sell products, the demand for these products is dependent on the economic conditions of those markets. So which means that if you're going to be investing in a particular foreign country or in a particular economy, and the economy is not doing well, it also means that your demand of your goods and services might end up not doing well, which means that your rate of return on the investment might not what end up doing very well as well. So which means that that's what might also affect what your rate of your risk, international risk exposures, mainly because of the what the demand of your the demand of your goods and services due to the movements and what the performance of what economic conditions where you're considering investing in as well. Then there's also exposure to political risk, where they say when multinational corporations establish subsidiaries in foreign countries, they become exposed to political risk, which arises because of the host government or the public may take actions that affect the multinational companies' what cash flows. Political risk is often viewed as what as a subset of what country risk as well. So which means when you look at exposure to political risk, this is where you look at the attitude of the government in what way you're considering investing in as well, because you don't want a situation where one day you are 100%, you are having 100% ownership stake in a particular in your investment that you've invested in a particular country, and then the next day the government says we are going to take away 51% ownership in you, and which means that you're only going to be left with what? 49%, because we want what? 51% local ownership as well. So which means that because of that, it basically means that this also exposes you to what? To political risk. And another source of political risk is where, for example, there can be political instability as well. Look at what has happened in Ukraine. If your company had invested in Ukraine and the next thing there's a war, it also means that what? You might have a situation where you are going to end up losing out on your investment, or on your investments, mainly because of what? Of the issue of that, of the war that is happening what? In Ukraine as well. So that's another issue that can also contribute towards what? Political risk. Another issue that falls under political risk as well is when we look at the terrorism, and where they say one form of an exposure to political risk is terrorism. A terrorist attack can affect a firm's operations and what? And its employees as well. That's why you see that for many multinational corporations, they are very good. They're having now have to do an intensive research if they're going to be considering what? Investing in a particular country, especially the country that is usually having what? A lot of what? Political instability. That's why you see that many countries across the SADC region were very much concerned about what was happening in what? In Nigeria, in Mozambique, when you look at the issue of the terrorist activities that were happening in the northern part of Mozambique, which is like the areas of Cabo Delgado, mainly because the international firms were also complaining that they will be losing out on their investments, mainly because of what? Issue of what? Terrorism as well. So are there any questions? Any questions so far? On the next section, we look at the overview of a multinational corporation's cash flows. And under this, they say, most multinational corporations have some local business similar to other purely domestic firms. Because of the multinational corporation international operations, however, their cash flow streams differ from those of a purely domestic firm. So here, we look at the cash flows. We start off by looking at the cash flows of a purely domestic firm that is based in the UK. So for a purely domestic firm or a UK-based multinational company, so it basically means that in this case, if the company is domestic, but they are basically the only foreign footprint that operations that they have is where they're doing import and exporting of what? Of goods as well. So which means if that is the case, we have a situation where they from their local customers, they sell to their local customers, and so which means that they are selling to their local customers, and what happens? The local customers are going to be making payments for the products that they're going to be selling to the local customers, and at the same time, for them to be able to produce these goods as well and services as well, they're also going to be making payments to the local suppliers within the UK as well. But at the same time, with the goods that they're also going to be producing, they're going to be having a situation where if they're going to be needing to import goods from other exporters who are outside the UK as well, it means that they're going to be making payments for the imports that they're going to be needing as well from where they're going to be that they're going to be needing as inputs to their production system. And at the same time, when they produce goods as well, they're also going to be selling these goods as well to the foreign customers as well through exports of these goods and services. So this is basically, so the first diagram is basically where you look at international trade, where you're looking at simple import and exporting of goods. And at the same time, you're also trying, the company is also trying to satisfy the local demand of their goods and services as well. On the next diagram, we are now looking at a more complex diagram now, where we're saying we're looking at the multinational corporation focused on international trade and international arrangements. And if we're seeing here, from the local customers and suppliers, they're doing transactions. They're also doing the importing and exporting of goods as well. And over and above that as well, they're also having a situation where they are now having services that they're also providing to foreign firms as well. And if they're having services that they're also providing foreign firms as well, they are now going to be receiving fees as well. And at the same time, they're also going to be having services that they're also going to be seeking from what? From foreign firms. So which means apart from only importing and exporting of goods, they are now also going to be looking at what? Importing and exporting of what? Goods and services as well. Then the next diagram is becoming a bit more complex, where you look at a multinational corporation focused on international trade, international arrangement, and what? Direct foreign investment. So in this case, we are looking at it from their local operations. They do the import and export of goods and services as well. And at the same time, they're now having a situation where they set up a subsidiary as well internationally. So if they set up a subsidiary internationally as well, the parent company is having to invest into the subsidiary. Then over time, the subsidiary now remits the funds back to the parent company. So this is where we're saying that apart from the simple import and export of goods and services, we're also having a situation where the parent company is now going to be investing or setting up what? A subsidiary as well. And the subsidiary now does the remittance of what? Of those profits as well. So this is a more comprehensive diagram which shows the operations of what? Multinational company. Is there any question regarding these diagrams? On the next section, we look at the valuation model for a multinational corporation. But before we look at the valuation model of a multinational corporation, we look at the valuation of a domestic company as well. So when you look at the value of the firm, if you still remember from undergrad, we said the value of a security today is the present value of expected future cash flow. So which means when you're looking at the domestic model, we're saying the value of a domestic company today is the present value of expected future cash flows. So what this formula basically is trying to say is where we are saying, when you look at a domestic company, let's say, for example, your company, you're expecting it to run operations over the next 1 to 3 years. So which means if it's expected to run over operations over the next 3 years, it means you will have an expected cash flow. So the company is going to be having an expected cash flow in year 1, an expected cash flow in year 2, and then an expected cash flow in year 3. Remember we said the value of a security today, or the value of a company today, is the present value of expected future cash flows, which means these future cash flows are being discounted back to present value. So you're going to be discounting these cash flows back to present value, and then the total of these cash flows becomes the value of the firm. And how do you discount these cash flows? You're going to be discounting these cash flows at a certain what? Discount rate. So you're going to be discounting these cash flows at a certain discount rate, which means when you're looking for the value, it's either you're going to be using the formula or you're going to be using the financial calculator there, right? Where we said with the formula, your present value is equal to your future value divided by 1 plus r to the power of t, right? So your present value is equal to your future value divided by 1 plus r to the power of t. So the future value in this case are these cash flows that we're discounting back to present value. And they're going to be discounted at r, which is the interest rate that is going to be discounted. And in this case, the t in this case is 1 period. You're discounting for 1 period. The t here becomes 2 periods. The t there becomes 3 periods. So which means that's how you find the present value of these future cash flows, and this will give you the value of the firm. So in simple terms, that's what they're trying to discuss there as well, right? But now, what do we know? For a purely domestic firm, it's easy to find the value of the firm because there's one element that has to be taken into account when you're looking at a multinational corporation, that there's what? That estimation of the exchange rates. So if you go on that section, they go on and say, so here they say, two major factors in valuing a multinational corporations are therefore returns as measured by the expected cash flows and risk is included in the discount rate. So here they also say, valuing international cash flows, unlike their domestic equivalents, multinational corporations engage in projects with a wider range of risk, even where the product is relatively homogeneous. Markets in different economies will differ more than in the same economy, and where relevant, the value of the foreign currencies will affect the revenue and costs. So it is important, therefore, to distinguish between project discount rates and overall company discount rates. They will not be the same. So projects must be discounted using the risk premium relevant to that project and must not be discounted using the average rate of overall cost of the company, respectively, of the project. So irrespective of the project. So here they say, the level of borrowing of a company should not affect the acceptance or rejection of a project. So as Modigliani and Miller showed, shareholders can adjust their investments to effectively choose their own level of gearing so as it can hardly play a part in valuation. So a minor exception to this picture are tax savings from the borrowings. These affect the level of cash flows to shareholders and may take a moderate degree of borrowing more profitable for the multinational corporation. So the independence of the shareholder risk preferences from the risk of the projects undertaken by the multinational corporation is known as separation theorem. So it means that directors do not have to ask the shareholders whether or not the project is too risky for them. They simply have to value each project according to the market risk and keep the stock market informed of any significant changes to the multinational corporation's overall risk as well. So this means, thus, the expected home currency cash flows can be received at the end of the period T are equal to the sum of the products of cash flows dominated in each currency times the expected exchange rate at which currency J could be converted into pounds. Remember here, the textbook is based on is basically based in the UK, so which means that in most cases, when you look at these examples, that's why you see that the domestic currency is presumed to be what? The British pound as well. So which means in this case, the expected cash flow equivalent in pounds would be given as the expected cash flow in the foreign currency multiplied by the exchange rate. So this will give you the equivalent pound cash flow. Then now when you find the equivalent pound cash flow, you're going to be converting it now back to, you're now going to be finding the present value of that equivalent pound cash flow. So which means that the value of your investment today is now, for a multinational corporation, it basically means that when you're trying to find the value of your subsidiary today, it basically means that this is the formula that you're going to be using there as well. So what it basically means is that when you are assuming that the company or the firm is pure domestic operations, we didn't have to worry. We were only worried about estimating these future cash flows going to the future, right? So that's the only problem that we're having to worry about estimating. But now, when you're now looking at a company that is having foreign operation, the next problem that we're having is to find out exactly what is the effect of the exchange rate. So how is the exchange rate going to end up affecting our estimation of the cash flows in the foreign market, so that we're able to find the equivalent expected cash flows in the domestic currency. So now, how is the expected cash flow in the foreign currency converted into the equivalent domestic currency is going to be affected by what? The exchange rate as well. So which means we need to find out exactly what is the exchange rate in period 1, what is the exchange rate in period 2, and what is the exchange rate in period 3. So what does that mean? The complexity here is where we are saying our capital budgeting or our assessment to say, is this a good investment or is it a bad investment? It's going to be based on our estimation of the exchange rate. And it's very difficult to know exactly what is the exchange rate going to be 1 year from now, 2 years from now, 5 years from now, or even 10 years from now as well. So which basically means that you might have a situation. So the problem here in estimating the exchange rates is that when you're now looking at a multinational corporation, you might have a situation where you're going to say, let's partake or set up the subsidiary based on your estimation of the exchange rate. But in most cases, the exchange rate don't necessarily the actual movements in the exchange rate don't necessarily mirror your estimated exchange rate. So which means you're now having a risk where you are now having a situation where you are risking accepting a project which you should have otherwise rejected, because your estimation of the exchange rate might be optimistic, and now you are being too optimistic that you end up accepting the project when you're supposed to reject it. Or on the other side as well, it can be a situation where you can be pessimistic about the movements in exchange rate or how the exchanges are going to end up affecting you, which result in a situation where you end up rejecting a project which otherwise you should have accepted as well. So this is where the movements, when you look at international multinational corporations as well, the valuation becomes a bit more complicated because of the estimation of the exchange rates as well. So the exchange rate element makes your assessment of a multinational corporation a bit more complex and difficult compared to a purely domestic operation as well. Are we on the same page there? Are we on the same page? Any questions? So on the next page, we look at the impact of financial management and international conditions on value. And here they say, multinational corporations recognize that they may increase their value by increasing their cash flow or by reducing their cost of capital. Hence, their challenge is to make decisions that will accomplish one or both of these objectives. So a multinational corporation financial decisions include how much business to conduct in each country and how much financing to obtain in each currency. So its financial decisions determine its exposure to international environment. And this is what we're going to be looking at when you look at the start unit, which is related to additional reading 3, where we're looking at multinational restructuring to say, over time, how do we ensure that we're able to maximize shareholders' wealth by choosing to say, how do we minimize our costs and how do we maximize our returns to say, so if that is the case, which currency are we going to be borrowing from? And over time, which currency do we have to pay back and borrow from another currency as well, depending on exactly which currency is going to result in a situation in us reducing our overall costs. And at the same time, you're also going to be deciding to say which currency are we going to be investing more in as well, so that we're able to maximize our returns. Because in the short run, if we're able to minimize our costs and maximize our returns, in the long run, that's how we're able to meet the goal of the firm is to which is to maximize shareholders' wealth as well. On the next section, we look at organization context. And when you look at the organization context, in this case, we're basically looking at the rundown of the overview of the different sections that we're going to be looking at there, where we are saying then the next chapters, although some of the chapters are going to be different from the study unit, so please make sure that you go on it according to the study units as well. So here they say, Chapters 2 to 5 looks at the background in international financial markets. Then chapters 6 to 8 looks at exchange rate behavior to try to see exactly how do you, since we said that movements in exchange rate are going to end up affecting what our multinational international financial management as well. How do we now understand the exchange rate behavior? Because understanding the exchange rate behavior allows us to now to be having what a more accurate estimation of the movements in exchange, so that we're able to what to make better capital budgeting decisions as well. Then chapters 13 to 16 looks at the long-term investment and financing decisions. And chapters 17 to 19 looks at the short-term investment and financing decisions. Then also, after looking at the exchange rate behavior, we also have chapters 9 to 12, which looks at the exchange risk management as well. So this is basically where we're now looking at what are the different risk exposures for a multinational corporation, and how do you mitigate these different risk exposure, like for example, economic exposures, translation exposures, and also transaction exposures as well. So it can be translation, transaction, and economic exposures, and what are they, and how do you mitigate them as well. So overall, the reason why we're doing all this is because we need to be able to mitigate our risk, and so that we're able to maximize our return. So at the end of the time, we need to make sure that for us to be able to maximize the shareholders' wealth, we need to minimize the risk as much as possible and maximize the returns as much as possible. Because if we're able to do this in the short run, in the long run, we're able to maximize shareholders' wealth, which is basically the value of the international firm as well. So study unit 1 basically looks at the overview of international financial management. So study unit 1 looks at the overview of the international financial management, which is basically looking at, and remember, please take note of this. When we're looking at Fin4802, try as much as possible to look at it from a perspective where we are saying that we're dealing with what? Multinational corporation. So let's end here today. In the next class, we're going to be looking at chapter 2, which looks at the international flow of funds, because this allows us to have a better background on it, understanding exactly, so what is the how does the international financial markets work, and how does now that you have the understanding of the international financial markets, the idea there is to find out exactly, so how do we come about in understanding the exchange rate risk and all other factors that also end up affecting what the valuation of the multinational corporation as well. So what we're also going to do in the next chapter is that I'll be highlighting things, I'll be utilizing this book, I'll share this book with you. Then what I'll also do is that I'll make sure that when I'm going through this book, I'll also highlight, if you're having the latest textbook, I'll also tell you exactly which sections or which page are they covering as well. Because remember, what I'll do is that I'll just make sure that I'll indicate to you what remember the prescribed version of the textbook. I think it's I can't remember which version it is, but I have it. So what I'll do is that I'll make sure that I'll also tell you exactly which page on this particular section that we're going through, which page is it in relation to to the prescribed textbook, so that we're able to work hand in hand, so that you don't also get lost as well. Are there any questions? Any questions? So please take note as well. When it comes to the assignments, a month or a few weeks before the assignment due dates, we are going to go through the assignments with you. So we'll go through the assignment with you a month or a few weeks before the due date. So what we do is we go through the assignment together in class. I send you the Word document, I'll send you a Word document, a Word printed that is in Microsoft Word, the assignment in Microsoft Word as well, so that you're able to now have a template that you can use now to answer your questions. But please don't just copy and paste. Make sure that you're able to customize to avoid issues of plagiarism. So that's for the two assignments that we're going to be going through. That's how we're going to be approaching them. a few weeks or a month before the due date, we go through the assignment together so that you understand exactly what is involved. I explain it in detail so that you understand it. Then after that, we'll make sure that I send you the Word document that you're now going to be using as a template. But please don't use the same Word document, but we will discuss that when the assignment comes as well, so that I give you a guideline of exactly how to approach it. But make sure that you understand the different concepts that are going to be asked in the assignments as well. So we need to cover as much ground as possible so that when the assignment becomes due, we would have covered as much of the material that is due for the first assignment as well. Also, for those who are attending for the first time that are not yet registered, the next class that is going to be done in April, you should be able to attend it for free as well, mainly because we are waiting for the registration period to end, and the registration period is ending end of March, which means that we are still expecting more students to join us so that we're able to have the classes as well. So you should just make sure that you communicate on the different WhatsApp platforms. That's where you'll be able to get the login information as well. And then once you are registered, please communicate with us so that we create a user account for you, because you should be able to access the videos and the material that you need on the website, so that you're able to actually have these videos to prepare for them in advance. Please communicate with us if there's any question regarding the registration process or anything like that. Please, I'm sure by now there are different you have been communicating either through us or through our admin on the different WhatsApp platforms as well. Please just communicate on those WhatsApp platforms with the parties that are facilitating your registration, so that you're able to get that information that you need for you to be able to register as well. Are there any questions? Also, for Fin4802, of the 3 modules that we offer, Fin4802, we are busy compiling the results as well. So we're getting busy compiling the feedback from the students who have written the exam in the Gen Fair, because it was the first module that, of the list of modules that we offer, it was the first module where the results came out as well. We have quite a bit of good feedback, because we have a couple of students already who have given us feedback that they managed to get distinctions as well. So you should know it's very easy for you to get a distinction, but make sure that you prepare. But what we'll do is, we're busy compiling that information, then we'll share that information with you as time goes by, once we are done getting the feedback from our students, from the last year's students as well. But the feedback for now, it looks quite good as well. So which means that it should be promising for us to say, we can be confident to say, you should be able to do, if you follow the same recipe, you should be able to pass the coming exams as well. Are there any questions? All right. Yes.
I have a question regarding the registration fee. Can you please explain the process? It's my first time attending your class.
All right. What we'll do is that we'll send you the registration form. That's why I'm saying, just communicate with us on the what. Remember, you've been having someone that you've been communicating with on WhatsApp, isn't it?
Yes.
Yes. Just go back to them, because usually they'll ask you for your email address. Then they will send you the registration form. Then from there, you are able to now fill in the registration form. Then they'll facilitate your registration as well. So just make sure that you communicate with the parties on the WhatsApp platform. They'll be able to give you all the information that you need. The reason why I'm saying this is because we have different platforms that we're basically utilizing for. So we have another administrator as well that is basically running our project as well. So because of this, we need to make sure that you go back with the administrators. They will be able to give you all that information that you need for you to be able to register. So just communicate with them on WhatsApp. They'll give you that information.
Noted. Thank you.
All right. Are there any other questions? All right. So
good morning.
Yes.
It's Busiso again. I just want to find out that based on what we've tackled today, I know that you don't want to overload us with information, but I just want to find out that will the sessions be sufficient for all the chapters that we should cover before the exam?
our timetable is that between now until end of October, that's when we should be done with the different study units.
Yeah.
And with our historical experience for international finance, usually beginning of October, we are usually done with the curriculum. We usually international financial management is usually one of the first modules that we finish on way before the set time than when you compare it with other modules as well. So don't worry about that. When you look at the historical experience, we have been able to finish that curriculum before end of October historically. So we are going to be able to finish on time. That I can promise you. Then remember, our timetable is between now until end of October. No matter what happens, we need to go to the study units. Then November, December, January, we need to be doing purely revision. So we know. So in some modules, but international financial management, I don't worry about it at all, because I know we'll be able to. We have never gone anything beyond end of October for us to be able to finish the curriculum. Usually, beginning of October, we are done with it. But in what we also do is, when you look at your timetable, it's based on the estimation of exactly what we should be done by end of October as well. If need be, usually for other modules, if need be, we set up other sessions in between. Because remember, towards the end of the year or sometime in September, October, if we see that we're a little bit behind schedule, what we usually do is that we communicate with our students and we set up additional schedules for us to be able to finish. Because no matter what happens, end of October, we should be done with the curriculum, with the study units. Then, so that we know that no matter what happens, November going onwards is purely revision period. So we are very much aware of that. And no matter what happens, end of October, we are going to be done with the curriculum, with the study units.
Alrighty, thank you.
Yeah, for international financial management, I'm not worried about it. I know we have never had a situation where normally beginning of October, we are done with the style. I remember in 2020, we finished around end of September, we were done with it in 2020. And in 2021, we finished it around the first class in October. That's when we finished the study units, because usually it's classes are twice a month. For the first class in October, we're done with the study unit, and you allocated the other time to just do general revision of the study units as well. So for international financial management, I'm not worried about it. Other modules, that's when you might find that there is a bit of material that needs to be covered, but it's not really that much. We no matter what happens, we always have to make sure that by end of October, we're done with the study units, so that November, we have to do purely revision. If we are not able to finish on time, you will see that towards the sometime in September, we'll announce additional schedules to be done either in September or October, so that we're able to finish on time. Because remember, what we have done is that towards the end of the year, we might have, if we're not able to finish on time, we might have some Sundays that we might now schedule classes as well. But that is in the case where we're saying we're a bit behind when it comes to finishing the schedule. But for international financial management, it has never happened historically. We have always been able to finish it way before the set time.
Just to add on what they are saying, sir, I think it will be much easier if you can share the document on WhatsApp after I finish the session, so that you can go through the chapters before for us to create a broader understanding. By the time you do the chapter, maybe I've covered the chapter myself, so that we can click on our side.
What we usually do is we are going to share the document with you. See, what usually happens is once you are registered on your user account on our website, you have there is a lot of information that is there. If you're not yet registered or you have not been facilitated to get the access to the user account on our website, there's a lot of information that you are still going to be exposed to. Because what on our website, once you are registered, you are able to remember all our sessions are recorded, which means before a particular topic is covered, we always make sure that we give you the video of how it was covered in the previous year. So you should be, once you're registered, you should be able to access those videos as well, so that you use those videos to prepare in advance. Then what we also do, so which means that by the time you get into class, you would have used the videos to study in advance as a guideline as well, so that when you come into class, you are basically knowing that, okay, there's this section, this section, this section, I didn't understand it. Because it's nice when you're doing online classes, it's nice when people ask questions, because it becomes what? A bit more interactive as well. So we like that because it becomes a bit more interactive, and we give even more examples for you to be able to understand as well. So which means once you are registered, you will be able to have access to the soft copy of the textbook. And what we're also going to do is that we're going to be making sure that as we go through the soft copy of the textbook that we use for demonstrative purposes, because the latest version, which is with the hard copy of the textbook, we don't have the soft copy of it. So we use the previous version, although we try as much as possible to give you a guideline. I'll just make sure that I bring my textbook next time, so that I give you a guideline to say, in the new textbook, this section is on this page. Then this is what we're going to be covering now. So this section that we're covering now is basically hand in hand with the new textbook based on that as well, so that we're able to go get it hand in hand. But also take note as well that another source of material that you have that is very useful is basically the videos, because the sessions of the class that we're having now, they're being recorded, the videos are going to be edited, and they're going to be posted on your user account as well, so that you're able to access the videos. Then also on top of that as well, we also have videos from last year that we also give you in advance, so that you use those videos to prepare for your classes. Then after you use those videos to prepare for the classes, then you can now come to class and now go to the class, ask questions on the section that you don't understand. Then whatever, if you miss the class, there's something that you still understand on the certain section, or later on in the year, you want to go back to a particular chapter as well, you're still able to do that utilizing what? The videos as well. So there's a wide range of things that you are still to be exposed to once you are registered and you have access to more additional material as well. Are we together? Are there any questions? All right, so enjoy the rest of your day, and we'll see you in the next class. And please try as much as possible to have access to the user accounts, because even those students who are on trial basis, we also give you a temporary access as well, so that you have limited access to the material that you need for the next class as well. So please communicate with the administrators there, because they'll be able to give you all that information as well. All right, enjoy the rest of the weekend.